price you see for silver is not the price you pay. On February 4th, 2026, COMEX silver futures closed at $79 per ounce. The Shanghai Gold Exchange closed at $93.22. The difference, $14.22 or 18%. This is not exchange rate distortion. This is not temporary dislocation. Physical silver in China costs 18% more than paper silver in New York because buyers in Shanghai are competing for actual metal while traders in New York are settling contracts in cash. This divergence has persisted for 6 consecutive weeks. The Shanghai premium exceeded 29% on January 30th when COMEX crashed 31% in a single session. After accounting for China's 13% VAT tax required to withdraw metal from exchanges, the effective premium reached 45.8% or $36.22 per ounce. This gap has appeared exactly twice in modern history. March 1980 during the Hunt Brothers Silver Corner, and May 2011 during the ETF buying frenzy. Both times, Western vault inventories drained to Asia within months. Both times, the paper price eventually converged upward to the physical price. The question is not whether this pattern will repeat. The question is how long Western industrial users can function without reliable access to metal at quoted prices. I'm John A.G., and this is the Collapse Files. Between January 1st and February 4th, 2026, the Shanghai silver premium over COMEX fluctuated between 10 and 29% on a raw basis. The pattern intensified following the January 30th COMEX crash. On that day, New York silver fell from $121 to $78, a 31% single-session decline. Shanghai silver fell only 8% from $109 to $101. The divergence created a $23 or 29% premium for Shanghai physical over New York paper. But the raw premium understates the true arbitrage opportunity. To remove silver from Shanghai Gold Exchange warehouses, buyers must pay a 13% value-added tax. This tax does not apply to international buyers who ship metal out of China, only to those who withdraw for domestic use. The VAT effectively raises Shanghai's physical price to $113 when COMEX trades at $78. The after-tax premium, 46.3% or $36.13 per ounce. Arbitrageurs recognize the opportunity immediately. Buy silver in New York at $78, ship to Shanghai, sell at $101 before tax, or receive $114 if selling to domestic Chinese buyers after they pay VAT. Subtract $2 for air freight, insurance, and handling. Net profit, $22 to $34 per ounce, depending on buyer type. On a 1,000-ounce bar worth $78,000 in New York, the profit ranges from $22,000 to $34,000. This is not basis trading or options arbitrage. This is buying physical metal in one location and selling the same metal in another location at massive profit. The mechanics of executing this arbitrage reveal why it persists. First, the arbitrageur must purchase physical silver from COMEX vaults or London dealers, taking delivery against futures or negotiating spot purchases. Delivery takes 3 days, minimum. Second, metal must be insured and shipped via air freight to Shanghai. Third, bars must clear customs and be deposited into Shanghai Gold Exchange warehouses before sale. Total elapsed time runs 10 to 14 days. During that period, prices can move significantly. If COMEX rises or Shanghai falls, arbitrage profit shrinks or becomes loss. This execution risk deters participants despite large gross spreads. Moving large quantities attracts attention. If multiple arbitrageurs ship simultaneously, vault operators may delay withdrawals or Chinese buyers may reduce bids. Financial institutions capable of executing this arbitrage face regulatory and credit constraints. Banks must allocate balance sheet capacity to commodity positions. Shipping physical silver ties up capital for 2 weeks without profit guarantee. Many prefer to allocate capacity to trades settling electronically. The arbitrage depends on specialized commodity firms with global operations, vault relationships, and freight arrangements already in place. The small number of capable firms means the mechanism operates slower than theory suggests. Perhaps a dozen firms worldwide can move multi-million ounce quantities between continents. Combined capacity might total 5 to 10 million ounces monthly. If Shanghai premium attracts even half that volume, COMEX registered inventory depletes rapidly. The arbitrage should eliminate itself within days. As traders buy in New York, prices there rise. As they sell in Shanghai, prices there fall. The spread narrows to the point where it equals transportation costs plus a small margin for execution risk. At that equilibrium, further arbitrage becomes unprofitable and prices stabilize. The Shanghai premium should compress to approximately $3 to $4 to cover freight, insurance, and financing costs. Instead, the premium has persisted above $10 for 6 weeks and spiked as high as $36. The persistence indicates that physical metal cannot move from west to east fast enough to close the gap. COMEX registered inventory available for delivery, stood at 38.2 million ounces on February 1st. This compares to 62 million ounces in December 2024. The 23.8 million ounce decline occurred over 13 months. If arbitrageurs attempted to ship 10 million ounces monthly to capture Shanghai premiums, registered inventory would deplete within 4 months. But actual monthly shipments are constrained by refining capacity, vault logistics, and air freight availability. Refiners report backlogs of 4 to 6 weeks to cast doré bars into 1,000-ounce good delivery bars that meet Shanghai specifications. Air freight capacity for heavy metals is limited because silver is dense and requires specialized handling. Most cargo planes prioritize high-value electronics over bulk commodities. Securing dedicated freight for 300,000 pounds of silver bars requires advanced booking and premium rates. By the time metal arrives in Shanghai, the premium may have shifted due to price volatility. China's export controls compound the supply constraint. Effective January 1, 2026, China designated silver a strategic material. Only 44 licensed firms can export silver, and each must meet minimum production thresholds of 80 tons annually and maintain credit lines exceeding $30 million. China accounts for 60 to 70% of global refined silver exports. The restriction removes approximately 35 million ounces annually from international circulation. Silver can flow into China, but cannot easily flow out. This one-way valve creates permanent pressure for Shanghai premiums. Lease rates provide additional evidence of supply stress. Silver lease rates in London spiked to 8% in January 2026. Normal lease rates run 0.3 to 0.5%. A lease rate is the annual interest charged to borrow physical silver for short-term delivery needs. When institutions pay 8% to borrow metal for 3 months, annualized borrowing costs reach 32%. This level appeared briefly in October 2025 before easing. The 4-week persistence at 8% signals structural shortage rather than temporary squeeze. Backwardation reinforces the shortage signal. The silver futures curve entered deep backwardation in December 2025 and remained there through early February 2026. On January 15th, spot silver traded at $2.88 above March futures. This inverts the normal relationship where futures trade at premiums to spot to reflect storage and financing costs. Backwardation means buyers will pay more for immediate delivery than for promises of metal 3 months forward. This behavior indicates distrust in the paper system's ability to deliver. Global silver price discovery operated for decades through COMEX in New York and the London Bullion Market Association. These markets set benchmark prices through futures trading and spot settlement. The Shanghai Gold Exchange and Shanghai Futures Exchange served regional roles, with prices typically tracking Western benchmarks within narrow bands. Arbitrage kept prices aligned across markets because silver is homogeneous and transportable. A 1,000-ounce bar in London has the same value as a 1,000-ounce bar in Shanghai, aside from transportation costs. The system functions when 3 conditions hold. First, vaults must contain sufficient physical inventory to meet delivery demands. Second, logistics must allow metal to move between markets within reasonable timeframes. Third, participants must trust that futures contracts will deliver physical metal when demanded. The Shanghai premium indicates that all 3 conditions are failing simultaneously. Western vault inventories have been drawn down through 5 consecutive years of supply deficits. Global silver mine production totaled approximately 850 million ounces in 2025. Industrial demand exceeded 600 million ounces. Investment demand added 180 million ounces. Total demand of 780 million ounces was met partially through mine supply and partially through inventory drawdowns and recycling. But recycling cannot scale to meet industrial needs because much silver is permanently embedded in products. Solar panels contain approximately 20 grams per unit. When panels degrade after 25 years, recovery is uneconomic. The logistics constraint involves refining and shipping capacity. Doré bars produced at mines must be refined to 99.9% purity and cast into standard sizes. London good delivery bars weigh 1,000 ounces. Shanghai accepts bars between 15 and 30 kilograms. The specifications differ slightly, requiring remelting and recasting when moving metal between markets. Swiss refiners who handle most international precious metals report 4-week backlogs. Capacity cannot expand quickly because building new refining facilities requires environmental permits and years of construction. Trust in futures delivery has eroded through repeated delivery squeezes. In January 2026, COMEX experienced delivery demand for 33.45 million ounces within 7 days. This exceeded registered inventory, forcing emergency transfers from eligible to registered status. Eligible inventory is silver stored in COMEX warehouses but not designated for delivery. Owners can reclassify it as registered, but they are not obligated. The fact that metal sits eligible while registered inventory depletes indicates owners prefer not to make metal available at current prices. The delivery squeeze mechanics work as follows. When a futures contract expires, holders can either roll to the next month, close the position for cash or demand physical delivery. Historically, less than 2% of contracts result in delivery demand. The system is designed for financial settlement with occasional physical delivery for those who genuinely need metal. But when participants lose confidence in paper markets, delivery demand spikes. If 5% of open interest demands delivery instead of 2%, the system strains. If 10% demands delivery, the system breaks. January's experience demonstrated this breaking point, with registered inventory at 38 million ounces and delivery demand reaching 33 million in 1 week. The exchange faced potential default. Vault operators scrambled to reclassify eligible to registered. Some owners complied, likely receiving premium payments for making metal available. Others refused, preferring to hold metal off-market. The crisis passed because enough eligible inventory transferred to registered status to satisfy immediate delivery demands. But each delivery squeeze depletes registered inventory further. Owners who transfer metal to registered status and see it delivered to Shanghai cannot repeat the process next month. The metal is gone. Future squeezes will face even lower registered inventory levels. This creates a death spiral where declining inventory triggers delivery concerns, which increase delivery demand, which depletes inventory further. The cycle continues until either prices rise enough to destroy demand, or the exchange changes rules to limit physical settlement. Exchange rule changes present their own problems. If COMEX imposes position limits or forces cash settlement, it explicitly acknowledges that physical delivery is no longer reliable. This destroys the exchange's credibility as a price discovery mechanism. Why would industrial users hedge on an exchange that cannot deliver metal when needed? Why would producers sell forward through contracts that settle in cash rather than physical offtake? The exchange faces a choice between defaulting on delivery obligations or destroying its own relevance by abandoning physical settlement. The entities trapped by this breakdown are industrial users, short sellers, and ETF-authorized participants. Industrial manufacturers need silver for production. Solar panel producers require 200 million ounces annually. Electric vehicle manufacturers use 90 million ounces. Electronics and semiconductor production consumes 250 million ounces. These industries cannot substitute copper or aluminum without multi-year retooling and performance degradation. They must have silver. When industrial users cannot source metal at COMEX prices because physical premiums have risen to $10 to $18, they face a choice: pay the premium or halt production. Many shifted to just-in-time inventory to minimize working capital. This strategy fails when spot markets cannot deliver reliably. Companies must return to holding larger buffer stocks, permanently removing metal from circulation and amplifying tightness. Short sellers who sold futures contracts at $100 and profited when prices fell to $78 now face delivery obligations. To cover shorts, they must buy metal in physical markets at premiums that erase paper profits. If they cannot source metal, they default and settle in cash. Cash settlement breaks the link between paper and physical markets. Once participants believe futures contracts will settle in cash rather than metal, futures prices become financial instruments detached from physical reality. The Shanghai premium reached 29% on January 30th, 2026. Shanghai closed at $101 per ounce. COMEX settled at $78. The raw premium was $23. Adding the 13% VAT brings the after-tax premium to $36.22 or 46.3%. This exceeds all premiums recorded during the 2011 silver peak, when Shanghai traded 12% above London at maximum dislocation. The January 30th spike occurred during COMEX's 31% crash, while Shanghai declined only 8%. Chinese buyers viewed the New York move as technical liquidation, not fundamental repricing. The 6-week average premium from late December through early February ranged between 10 and 18% on a raw basis. The lower bound of 10% translates to approximately $8 per ounce, when COMEX trades near $80. The upper bound of 18% equals $14.4. Adding $2 for shipping and insurance, the arbitrage profit ranges from $6 to $12 under normal conditions and spiked to $34 during extremes. These are not basis points. These are large absolute dollar amounts that should attract arbitrage capital. Lease rates quantify borrowing stress. The 8% rate in January means institutions borrowing 100 ounces for 1 year must return 108 ounces, or pay cash equivalent. For 3-month leases, the rate annualizes to approximately 32%. Gold lease rates during the same period were 2%. The 6 percentage point spread between silver and gold indicates silver faces supply constraints that gold does not. When lease rates exceed returns available from other assets, it signals scarcity value has increased beyond financial yield. COMEX inventory dynamics revealed drainage pace. Registered silver fell from 62 million ounces in December 2024 to 38.2 million ounces in February 2026. The 23.8 million ounce reduction occurred over 13 months. Average monthly decline, 1.83 million ounces. If this pace continues, registered inventory depletes to zero within 21 months by November 2027. But depletion will accelerate if Shanghai premiums persist and arbitrageurs increase shipments east. Total COMEX inventory of 299 million ounces includes 261 million ounces classified as eligible. Eligible metal is stored in approved warehouses but not available for delivery. Owners can reclassify to registered but are not required. The gap between total and deliverable inventory creates the illusion of supply. The ratio of open interest to registered inventory quantifies leverage. Open interest of 140,000 contracts equals 700 million ounces. The ratio, 18 to 1. For every ounce available for delivery, 18 ounces of paper claims exist. Shanghai Futures Exchange inventories fell from 980 tons in January 2025 to 410 tons in January 2026. A 58% decline in 12 months. These inventories represent 13 million ounces. At current decline rates, Shanghai inventories reach critically low levels by mid-2026. Chinese industrial demand exceeds 150 million ounces annually and is growing due to government support for solar energy and electric vehicles. The backwardation of $2.88 on January 15th represented 3.2% of spot price. Storage and financing costs typically run 1 to 1.5% annually. A 3.2% backwardation implies market participants are willing to forego 3.2% returns to hold metal immediately, rather than accept delivery in 3 months. This preference for possession over promises reflects declining trust in paper delivery systems. Mine production has been flat since 2015, fluctuating between 820 and 870 million ounces annually. New projects require 5 to 10 years from discovery to production. Current capital expenditure is insufficient to expand supply meaningfully before 2030. Major producing regions show declining output. Mexico saw production fall 3% in 2025. Peru declined 2%. Ore grades are falling and energy costs rising across the industry. The Hunt brothers. Silver manipulation of 1979 to 1980 provides the closest parallel. Nelson Bunker Hunt and William Herbert Hunt attempted to corner the market through futures purchases and physical accumulation. By January 1980, they controlled approximately 100 million ounces. Silver reached $50 on January 21, 1980. Backwardation exceeded $3. Lease rates spiked above 20%. COMEX raised margin requirements and imposed position limits to break the corner. Silver collapsed from $50 to $11 between January and March 1980. Silver Thursday on March 27th saw a 31% single-day decline when the Hunts defaulted on margin calls. The parallel to January 30th, 2026 is exact. Silver fell 31% from $121 to $78 following CME margin increases. The mechanism was identical, leverage flushed through forced liquidation. The 2011 silver peak offers another precedent. Silver reached 49 magnitude to $82 on April 28, 2011. ETF inflows and retail coin demand drove the rally. COMEX raised margins 5 times in 8 days between April 26 and May 5. Margins increased from 11 to 18%. The forced liquidation drove silver to $33 by May 12th, a 34% decline in 2 weeks. What distinguishes 2026 from 1980 and 2011 is the role of sovereign demand and industrial consumption. In 1980, the Hunts were speculators. In 2011, retail investors drove demand. In 2026, governments designate silver strategic. Solar manufacturers cannot substitute without multi-year retooling. Electric vehicle producers require silver for every unit. This demand is inelastic. Margin increases cannot eliminate it. What most people miss, the mainstream narrative attributes Shanghai premiums to capital controls and VAT taxes. This explanation is incomplete. Controls and taxes existed when Shanghai traded at parity with COMEX. The recent premium reflects a shift in willingness to pay elevated prices for immediate possession. Chinese buyers express preference for physical metal over financial exposure to Western markets. This preference is strategic, not merely financial. China's January 1st export controls formalized a policy of securing domestic silver supply for industrial use. The Belt and Road Initiative created demand for Chinese solar panels, batteries, and electronics across Asia, Africa, and the Middle East. Fulfilling these contracts requires securing input materials. By restricting exports and tolerating high domestic prices, China ensures its manufacturers have access, even if it costs more than international benchmarks. The second-order effect involves Western industrial capacity. If European and American manufacturers cannot source silver reliably, production shifts to Asia, where metal is available. This accelerates deindustrialization. The solar industry provides a clear example. Western manufacturers pay spot prices plus $10 to $18 premiums for physical delivery. Chinese manufacturers pay higher absolute prices but have secure access. Reliable supply outweighs price disadvantage over time. The wealth transfer inherent in the arbitrage gap goes unnoticed. Every 1,000-ounce bar purchased in New York at $79,000 and sold in Shanghai at $93,000 generates $14,000 profit. This profit comes from Western vault owners who sold metal at $79 to arbitrageurs. Sophisticated institutions with global operations capture the arbitrage. Smaller holders receive only the paper price, creating wealth transfer from distributed smallholders to concentrated large players. Media coverage focuses on price volatility rather than structural shortages. Headlines emphasize the 31% crash, but ignore the 8% lease rates and 18% Shanghai premiums. This framing reinforces the perception that silver is speculative. The underlying reality that industrial demand exceeds supply receives less attention because it lacks dramatic appeal. The Shanghai premium draining Western vaults is a liquidity event in slow motion. Liquidity events occur when assets presumed available become unavailable at prevailing prices. The silver market is discovering that metal priced at $79 on COMEX is not actually available at that price in physical form. To obtain metal, buyers must pay $90 in New York or $114 in Shanghai after taxes. Paper and physical prices have diverged beyond arbitrage correction. This divergence affects confidence in all commodity markets operating through futures exchanges. If silver futures cannot deliver metal reliably, questions arise about copper, platinum, and other industrial metals traded on similar structures. The leveraged nature of commodity futures depends on the assumption that physical delivery is available when needed. If that assumption breaks, the entire system of price discovery through futures comes into question. What breaks first historically is short-term lending markets. When lease rates spike to 8%, institutions with short positions face unsustainable borrowing costs. Shorts must either close positions by buying metal or default on lease obligations. Buying drives prices higher, triggering margin calls and further short covering. Defaults destroy confidence in lending markets and reduce future supply of lendable metal. Both outcomes accelerate the transition from paper to physical pricing. Industrial users who cannot source silver reliably begin hoarding. Hoarding amplifies shortages because inventory that would normally circulate becomes locked in corporate vaults. This creates self-reinforcing cycles where perceived scarcity drives actual scarcity. Just-in-time inventory models break down. Companies return to maintaining larger buffer stocks, permanently removing metal from circulation. The geopolitical dimension involves strategic resource competition. Silver is the most conductive element for electricity and heat. Technologies defining the 21st century, solar panels, electric vehicles, 5G infrastructure, AI data centers, depend on silver. If supply constraints prevent Western nations from accessing metal, technological leadership shifts to regions that control supply. China's export restrictions represent a strategic decision to prioritize domestic technology development over export revenue. On February 4th, 2026, the Shanghai silver premium stood at 18% over COMEX. Shanghai closed at $93.22. COMEX closed at $79. The $14.22 gap has persisted for 6 weeks. This is not temporary dislocation. Physical metal cannot move from west to east fast enough to equalize prices because Western vaults are depleting and China has restricted exports. Registered COMEX inventory fell from 62 million ounces to 38.2 million ounces in 13 months. Lease rates of 8% signal acute shortage. Backwardation of $2.88 indicates buyers prefer immediate possession over future promises. China's export controls remove 35 million ounces annually from circulation. Industrial demand exceeds 600 million ounces. Mine supply is flat. 5 consecutive years of deficits have reduced inventories to critically low levels. The silver market is transitioning from a financial asset priced by futures exchanges to a strategic commodity allocated by governments. This transition is not smooth. The January 30th crash demonstrated exchanges will intervene to prevent delivery failures, but intervention cannot create physical metal. It can only redistribute existing supply through price manipulation and forced liquidation. The 18% Shanghai premium is not a number on a screen. It represents metal leaving London and New York vaults and accumulating in Shanghai. Each 1,000-ounce bar that ships east permanently depletes Western inventory. When inventory reaches critically low levels, European and American industrial users will compete for remaining supply. Physical premiums in the West will match or exceed Asian premiums. The paper price becomes irrelevant. Metal trades at whatever price secures supply. This is not financial advice. This is observation of market structure under stress. The structure is revealing that leverage of 370 to 1 cannot coexist with sustained physical delivery demand. Either delivery demand recedes through price destruction, or the paper system breaks through inventory depletion and delivery failures. January's crash attempted the first path. The persistence of 8% lease rates and 18% premiums suggests it did not succeed. The second path remains in progress.